President Trump escalating his tariff plans, announcing reciprocal levies on several countries coming next week. A 10% charge on Chinese imports has already taken effect. Meanwhile, deals were made with Canada and Mexico to put a temporary hold on new tariffs until March. My guest has been crunching the numbers on true economic and inflationary impact. Joining me now is Apollo Chief Economist Torsten Slok. Torsten, thanks for coming by, checking out the new seats with us.
Thanks for having me.
So, of course, we don't know exactly what tariffs will and won't be put into effect, but you took the information you had, which was a threat of 25% on Canada and Mexico, 10% on China. You ran those through your spreadsheet. What did you find?
Yeah, so there are several institutions that have quantified the impact if you put 25% tariffs on Canada and Mexico and 10% on China. And what they do find is that GDP growth will tend to be modestly lower by 0.4. And we will see over some time, of course, these effects will begin to show up as gradually lower GDP, simply because when the price of something goes up, people tend to buy less of it in shops.
Now, those numbers do not include the effect of any retaliatory tariffs that other countries might put on us. I realize you don't know what those numbers are, so you can't put them in your spreadsheet. But you're an economist. Give us a sense of what they could mean.
Yeah, so it depends a lot on the magnitude of the numbers. But it's clear that if we do get retaliation, and then we might have the U.S. retaliate back again, and we do get a true full-blown trade war, then the implications might be bigger. But we just don't know at this point what exactly that will look like and to what degree that might play out.
And you said there's an uncertainty factor, right? You were able to chart the uncertainty of current policy.
Yeah, there are some academics, Becker, Bloom, and Davies, who have quantified a measure of uncertainty, specifically of trade policy uncertainty. And what they find is that trade policy uncertainty is today at levels that are quite elevated, even relative to where we were in 2017 and 18. So in that sense, that uncertainty might also begin to have some implications for business spending decisions. So overall, uncertainty is, of course, something that means something for business planning, and business planning may therefore also potentially be negatively impacted.
All right, there's so much going on in Washington right now, there's no way we can cover it in one show. So putting it all together, what do you think, what policies will have the biggest impact? What will that impact be?
Well, I think the focus in financial markets has been and should be on the three things that really matter for the economy, namely what's been going on with tariffs, as we just talked about, but also what might not be coming on immigration, and finally also what might be coming on tax cuts. It happens to be the case that tariffs lifts inflation modestly. If you have restrictions on immigration and deportations, there is 11 million unauthorized immigrants in the U.S., roughly half of them, namely 6 million, have a job. They work in three different sectors: agriculture, construction, and in services. So if you do begin to have a more meaningful negative impact on those sectors, that could also mean higher inflation, in particular wage inflation. And finally, if you also begin to see lower corporate taxes, in particular for domestic manufacturers, that could potentially also mean some modest boost to inflation. So the conclusion is we could see inflation begin to move a bit higher from an already relatively high level, currently at 2.9%, that therefore might begin to raise some risks, in particular for the Fed.
So that's the economics of it. Give us what the market should be thinking as an investor, any portfolios adjustments because of all this.
Well, I do think that given we already have a very strong economy, GDP growth for the last 2 years has been remarkably resilient. And GDP growth at around roughly 3% for the last several quarters. And we have inflation at very round numbers, also around 3%. If we add these policies on top of that, with more tariffs potentially coming, some restrictions on immigration, potentially lower taxes, it does run a little risk that inflation could potentially be a bit higher over the coming quarters. And therefore, the answer to your question, Jack, is that that could imply, therefore, that interest rates are likely going to stay higher for longer. It will be more difficult for the Federal Reserve to cut interest rates simply because the economy is already strong. And on top of that, we might also have some upward move in inflation.
And so given that you're not crazy about small caps, which often have a lot of debt at fairly high rates, the Mag 7 dominates the biggest parts, so you're looking for the Goldilocks right in the middle of the market there?
Yeah, I do think the challenge for the Russell 2000, the small cap stocks, is that 40% of companies in the Russell 2000, they have negative earnings. And when companies have negative earnings and interest rates are high, that means that it's more challenging for them to pay their debt servicing cost. And for the Mag 7, the challenge is that they make up now 40% of the S&P 500. So they are buying them is completely in contrast to the page 1 in your finance textbook, which says you should be diversified. So that's why value companies mid-market, mid-cap, that have earnings and therefore are able to pay for the debt servicing cost and are not too expensive, it does seem to be the right place to be.
We have to leave it there. As we leave, I do want to show you a chart showing the deficit, or excuse me, the national debt. It's practically going parabolic, and that's scary. So stay at the short end of the curve in fixed income, I imagine.
Yeah, the challenge is that not only are short-term interest rates going to be higher because the economy is strong, but what this chart here shows you, debt to GDP is about to go up. This is forecast from the Congressional Budget Office. Today, debt to GDP is 100%. It's going up to 200%. So short-term interest rates are high because the economy is strong, and long-term interest rates will also remain high because the economy is strong. And on top of that, we also still have some fiscal challenges that likely also will put upward pressure on long-term interest rates.
Torsten Slok, thank you so much for coming by. Enjoy the Super Bowl.
Thank you.